welcome back to another week of market updates here. It is June 2nd, 2023, Friday morning here. This is Kelly coming to you with another week of exciting updates. So let's get right into the markets. Despite the shortened week here with the Memorial Day holiday, it was not a boring week by any means. So we saw a resolution mostly of the national debt ceiling crisis. I think it got to the president. So that's really important there that we are towards a resolution there. We had a really unique jobs report this morning for the month of May, and overall we had equities go higher for the week. As of Thursday, June 1st, the NASDAQ was up about 1%, the S&P up about 0.4%, and the Dow Jones just about flat at negative 0.1%. So not a whole lot of gains this week, but definitely still in positive territory. Starting out into our economic data of the week, we got our consumer confidence survey for the month of May, slipped to about 102.3 here from April's 103.7. So not a huge loss there, but definitely a decline in confidence in consumers. So I think the more interesting data though comes from consumers' responses to key economic questions, especially in talks of inflation and labor market. So inflation expectations for the May survey, they sat at about 6.1% of an inflation rate expected over the next 12 months, despite the current inflation rate really being towards 5%. So at the same time, we saw the percentage of consumers who perceived job opportunities as plentiful decreased from about 47.5% to 43.5% in just 1 month. While on the other hand, consumers who found jobs hard to get increased from about 10.6% to 12.5% in May. So really important data here as we are looking at the job markets and other important economics of the week. And all of this is really demonstrating consumers are increasingly aware of economic situations, especially this one currently, and they are still feeling the pressures of inflation for sure. Another important data point of the week, we got the Shiller National Home Price Index for the month of March. So we saw home prices were up just about 0.66% from 1 year ago. So not super huge gains there, but they were up about 1.26% in March just from February. So a bit of an uptick in home prices. But again, a lot of that is the typical spring home buying season that comes along with the industry. So, despite this being one of the more interest rate sensitive markets, the real estate, especially residential real estate, it has surprisingly remained fairly resilient in this macro landscape, at least for now. So really important stuff to see as we are seeing how the consumer is doing and how we should make investment decisions based off of that. Also this week, the May ISM Manufacturing Index, really big telltale sign of the manufacturing world and the goods economy. So here we can see got to about 46.9 in this report here, down from April's 47.1. So, this is not a huge slip, but it did pull the 12-month average down to 49.2%, which again is a recessionary almost, definitely a contracting manufacturing industry as kind of the goods economy, the goods side of the economy slows on this backdrop of changing demand and higher interest rates. Finally, last big data point of the week, we got the May jobs report here on Friday morning, and that definitely shifted the Fed funds rate probabilities quite a bit. So we'll jump into that in a little bit. But here you can see the unemployment rate ticked up to 3.7% in May, which was much higher than the estimates of 3.5%, and also a big jump from April's 3.4% unemployment rate. You can see it's also the highest since last October, so quite a higher rate than what we've been seeing in the last few months. But again, 3.7% unemployment is still quite healthy, still quite a robust labor market, especially when we look at the non-farm payrolls in a second. Average hourly earnings grew as expected at about plus 0.3%, while the average work week fell just 0.1 hours from April to 34.3%, relatively unchanged. The big shocker of this jobs report, though, was the additional 339,000 jobs that we got in May here compared to the about 200,000 expected. It's also the largest gain since January here, so definitely a big gain with the professional and business services adding the most, second by government and healthcare industries as well. So definitely seeing growth in those professional jobs as others, manufacturing and those sorts of things decline a bit. And, despite the higher unemployment rate, all of this, again, is still pointing to quite a robust labor market, something that's definitely going to play a role in the Fed's thinking on monetary policy as we come up just about a week and a half from this next meeting here. So we'll jump into how the Fed funds rate probabilities move this week, and I think a lot of that had to do with this jobs report for sure. With the hotter than expected inflation data that we got in last week from the PCE report, we had a pretty high probability starting off this week. This is just as of Tuesday here, right after the holiday, that I took this screen grab of the Fed funds rate probabilities. With that hotter inflation report and with just all the other economic data points that we had at that point, 71% of another rate hike, just a 25 basis point rate hike, but still pricing in another hike at the June 14th meeting. By the end of this week, June 2nd, we had the complete opposite scenario as the jobs data had a big impact on that and just how the market is digesting a lot of this information. So we'll look at that next. So you can see as of June 2nd here, this Friday morning, we had almost a 70% chance of a rate hiking pause. So definitely a big move in terms of, the jobs gains showing out really strong, much stronger than expected, and just other data points feeding into the market that they think that we're really, leaning towards more of a pause rather than another hike here in just about a week and a half. So, we also had other Fed members speaking out saying that they believe in a pause, so maybe that had some impact on it as well, but just really important stuff to keep track of as we, adjust our portfolios as appropriate given the current circumstances. Throughout all of this craziness and this crazy economic situation that we find ourselves in, we just feel really appreciative and we are very thankful for you tuning in. So thank you so much, and we will see you next week here.